Right, so that takes us into the next session, and it's a really relevant one. No doubt you would have seen maybe a lot of discussion around the concept of longevity risk, which is about outliving your retirement savings, basically. And current situation aside, we are seeing the statistics of life expectancy increasing into the future, which probably indicates why the government is making some of these moves to extend the ability to allow you to contribute to your superannuation further into your life. And this session, I should say, is being presented by Paddy McCrudden. He is the Head of Retirement Solutions and Data Science at Magellan. So let's welcome Paddy to the virtual platform.
Fantastic. Okay, well, let's get into this. So we've just gone through a very technical but incredibly useful talk on the nature of contributions to super. I want to shift gears a bit to talk about the investment perspective. So once you have your super there, how do you invest? So let me start with something that would be on some of your minds right now, and if not now, it will be over the next year or so. And this is the retirement income covenant, which is about the obligations of all trustees of super funds. So the basic obligation here is that Treasury proposes to place an obligation on all trustees to develop a retirement income strategy. And so what does that mean? So Treasury spelled it out very clearly in their most recent document, which was released in about July, which states that the strategy has to talk about maximizing your retirement income, about explicitly managing the risks to the sustainability and the stability of that income, and along with having some flexible access to savings during retirement. And this requirement will apply for all trustees, including the trustees of SMSFs. So, and this is going to start in about a year or so, in July next year. Now, I'm sure many of you are, sighing, thinking, "Oh my goodness, the regulatory obligations of managing these funds are complicated and getting increasingly so. And will this have an impact on me?" So I actually don't want to talk about that side of things. I just want you to think about the sensibility of these three targets that the Treasury has asked us to think about as trustees of super funds. So one, maximizing your income; two, managing the risks and having access to savings. And I think we can all agree that these are pretty much the goals that we're trying to get to in retirement. So over the next 20 minutes, I want to talk about how we can think about these objectives in retirement investing. Okay, so look, the way that we think about these objectives is that we want regular income that keeps up with inflation to meet your everyday cost of living. But this should be backed by capital growth, so that this money can last into the future in an unknown horizon, and hopefully a bequest wish for others. And obviously, access to savings is critical for retirement investors. So let's think about why this is difficult. The problem here really is that these goals, these three independent goals, are in acute conflict. So if you just step back and you think, look, while you're accumulating assets, what is it that you really want? Well, typically you just say, I want more money at my sort of target date at the end of my working life, with the least amount of risk. And so that usually leads people to just sort of working out their risk tolerance and then just creating investment strategies to match that. But when you get to the retirement phase, things become more tricky because, getting a predictable income out of investment assets often means a lower income with limited or no growth. For example, if you buy, I'm sure you're all well aware that the RBA cash rates are less than 25 basis points at the moment. So that's really not giving you much. Fixed income in the longer duration is also very challenging. Look, investing for growth is another alternative, and that is increasingly seen as a good solution. But this also comes at the cost of risks. And then finally, insurance-based solutions, which are not particularly popular at the moment, they can provide predictable income, but given the low rates of return right now, they do come at a cost of a low rate and limited typically or no access to your capital. So these objectives that we're trying to solve in retirement are in conflict. Okay, so moving on to thinking about growth assets, I think SMSF trustees, advisors, and investors in general are increasingly seeing growth assets as a core part of the solution. Just as some interesting facts that, look, Aussie and US shares have provided the highest inflation-adjusted return amongst all asset classes since about 1900. So in the long run, they've been very effective in growth assets. And even though they come with risks, it typically does lead to higher median balances with a high allocation to growth assets. And as many of you are aware, that whilst there is risk, then the Australian government pension is always there to provide support for those who have lower balances there. So this analysis using the presence of the Aussie government pension shows you that there is a pretty high optimal allocation to growth assets. Okay, so I think most trustees are already there on this fact that growth assets are a necessary part of the solution. And so the question then becomes, well, why is it so difficult to allocate? And I think the answer here is around volatility. So simply put, when you're accumulating assets, vol can be your friend. So if you add a regular amount into your super, as many of you have already done, you end up buying more shares when prices are low. So this is known as dollar cost averaging, and it's a very widespread tool for accumulation investors. But when you get to decumulation or withdrawing, it's exactly the opposite. So when you withdraw a regular amount to meet your monthly expenses, if you have to sell your assets to fund that when prices are low, then you obviously have fewer shares, less to compound when they recover. And so this leads to what's known as sequencing risk. So it now matters the order of your returns. And this is really the problem for investing in growth assets when you're in retirement. Okay, so how can you manage this vol? Like, what are the tools that we have to go about meeting these problems? I would say that there's two broad categories of solution. So the first is number 1 and 2 here, which is on how you change the way you spend or take your income. And number 3 and 4 is something about your portfolio solution, about your investments. So look, one is just if you generally reduce your spending rate all the time, then you have less sequencing risk. Okay, great. But that's not really solving the problem, because we're here to spend our retirement savings. The second thing is you can adjust your portfolio, your spending to portfolio performance. So if asset markets fall, then you reduce your spending. Now, that sort of works, but it's not very useful, because you can't go into Woolworths and say, look, the share market's down 20%. I'm going to pay 20% less for my groceries this week. So that number 2 is not really getting at the solution either. So there have to be 2 other approaches based on investments. And so the first is to reduce portfolio vol, and the secondly is to draw from a buffer asset somehow outside your portfolio. So I'm going to now go into those 2 components. So first, portfolio solution. The first part of this is to focus on low risk, high quality defensive equities. So of course, the temptation is to remove the vol entirely from your investments, but then you're kind of left where you started with little or no growth. So you need to continue to invest with growth assets, but you've got to think about how you can reduce the vol without reducing the expected return. And you should, of course, focus on those assets that have good downside characteristics. So ones that where asset markets fall, those securities tend to have a better performance. And there's a lot of evidence that investing in low risk, high quality defensive equities can give you market-like returns with lower risk. So that's your sort of starting point for what you should be doing on the portfolio side. The second point is something that many of you would already be using, and this is called reserving or bucketing. It's also known as time segmentation in the US. So investors have developed techniques for managing this, where they typically think of breaking their investments out into a couple of blocks. So one is a growth bucket, and then secondly, a cash bucket. And the cash bucket is typically sized in time. So that it's like, I need 24 months worth of income in the cash bucket, or 36 or 24. And the idea here is that this is the period over which the investor feels comfortable that they can use that cash to provide their income without needing to sell their growth assets. And this is a very widely used practice, and mainly because it works. So with this as background, Magellan started working on producing a product that can capture these insights in a single fund and make it accessible and easy to use. So we introduced Magellan Future Pay, which was launched in June this year. And simply put, it's an actively managed fund. So it's a fund that you can go and buy. And it has 4 key things that it's aiming to deliver. The first thing, it is aiming to deliver a predictable monthly income that grows with inflation, and it's a fixed dollar amount. So it's not a percentage of your equity assets, it's a fixed dollar amount. Underneath this, it's driven by an investment strategies that have capital growth equities with a very, very, very stern focus on downside protection. Alongside this, we've taken the concepts of bucketing and made them very efficient and very effective to support income in those bad times, to avoid needing to have to sell assets. And, you know, as per the key opening requirement, this also has daily access to your capital. Okay, so let's just quickly drill into these 2 sides of it. As I said before, you're going to need to think about 2 sides to it. So the first is the portfolio solution. And this is where Magellan uses its very long proven track record of investing in low vol, high quality global companies with a focus on downside risk. So that's what the investments consist of. Alongside this, there's a structural solution where Future Pay has access to a so-called support trust, which is uniquely designed to implement this reserving strategy that we talked about to benefit all members. I should just mention right now that the structural solution, the reserving pool, currently is sitting there with about 31 months worth of income in it. So if you invest today, there's already those reserves that have been built up to support you in difficult times. Distributions, so monthly payment, the fund distributes on the 15th of the month, every month, just like a paycheck. And it's paid early if it's not a business day. In fact, I got a text message from my mum yesterday, which was the 15th of the month, saying she got her first paycheck from Future Pay. So every month it turns up in your bank account. The current distribution's about 2.05 cents per unit, which equates to about a 4.1% yield. So that's, if you put in $100 today, you're going to be getting $4.12 income over the next year or so, approximately, adjusted for inflation. So it'll go up with that. And it's not contingent on whether the asset markets go up or down. Okay. If you're interested, how do you access it? So there's a couple of key ways to access it. So the first is you can apply directly to the fund, and that's through the unit registry, and you can look on our website for the information there. Alternatively, this has been made accessible through the stock exchange, Chi-X, ticker is FPAY, and it's traded just like any other quoted security. So you can go and buy securities and then sell them, of course, anytime you wish. All right, so just in summary here, the goal here for FuturePay was to develop a single product that captures the key elements of that meets retirees' needs, but uses the important portfolio and structural risk management techniques to get this right. And so what does it do again? It's just a managed fund. So just like any other fund, it provides a predictable monthly income that grows with inflation, underpinned by a very conservative, low volatility, high quality investments in equities. It's supported by a reserving strategy so that the need to sell assets when they've fallen in value is reduced, and along with access to your capital daily. We've just also added there that we've engaged independent actuaries, Rice Warner, now Deloitte, to analyse this, and they've analysed it in the context of the whole Aussie retirement landscape with a focus on SMSFs. And they do say that investing in FuturePay can provide considerable uplifts in both income and accessible capital through retirement.
Investing for retirement is complicated. In a perfect world, a retirement investment would deliver investors three key outcomes: a regular, predictable, fixed dollar income that grows with inflation to support ongoing needs, easy access to savings to meet any unexpected or large expenses, and the protection and growth of those savings, ensuring they will last for the duration of our retirement or can be passed on to our loved ones. The challenge is that these goals compete with one another, and this may force us to make unacceptable compromises. In retirement, investors typically choose one or more of these investment options: cash and fixed income, annuities, or equities. Let's take a look at these in more detail. Cash and fixed income, such as term deposits or bonds, are generally lower risk investments and can be liquid, meaning they give us access to our savings at any time. But thanks to record low interest rates, income from cash is now below inflation, negative in fact in real terms. Annuities can provide us with a salary replacement in retirement, but access to these savings can be limited or come at a cost, making them less attractive for some investors to accept. Equities are a popular option that have the benefit of growing capital over the long term, but they too can come with their own risks, notably market volatility. And as we've seen, a global crisis can affect even safe haven blue chip bank dividends. While growth assets, such as equities, are important for investors in retirement, the volatility of equities can also expose investors to something called sequencing risk. This is the risk that arises when, in order to meet your regular income needs, you withdraw from your investment portfolio during a period of poor investment performance, and you may not be invested when investment markets bounce back. For more information on sequencing risk, we encourage you to watch the other videos in this series. To date, there has been no simple yet comprehensive solution available for retirees to both meet their retirement objectives and mitigate sequencing risk. And many of us are left having to choose an investment option that doesn't meet all of our needs, requiring us to accept compromises and live with the financial and emotional challenges that these choices create. At Magellan, solving for investors is embedded in our DNA. We ask the question, what if you could use equities in retirement to maintain your income while significantly reducing the associated risks? And we've developed a unique solution that is designed to do just that and to help you lead a calm and confident retirement. Welcome to Magellan Future Pay, a growing monthly income now and into the future. For more information on Magellan Future Pay, please read the product disclosure statement, talk to your financial advisor or visit magellanfuturepay.com.au.
Hi, Paddy. Thank you very much for that session. Some great and powerful investment techniques I think you covered off there, which is fantastic. I do have a few questions for you. The first one's actually more about the market conditions. And it's about whether or not you're predicting as a fund manager a correction to the market this year.
Well, people with crystal balls can make predictions, but I tend to avoid them. So look, Magellan, I think, a lot of people are concerned about markets. It's very high PE. It's had a very good run, especially since the start of the crisis. But we currently are, with a moderate risk tolerance. So we're comfortable that these are not extraordinarily overvalued, and, we're not preparing for a rapid market correction. But we do think it's something to keep your eye on.
As you can see, it's been answered by text as well, but just a question about what the fee rate is for a $1 million investment in the fund.
Yeah, no, thank you. So the fee is a flat fixed fee of 1% of the equity investments. So we don't charge a fee on any of the support trust assets there. So, 1% times $1 million, which is, I guess, 10 grand.
I've got a sort of a philosophical investment question for you, Paddy.
Thanks, Dan.
The Future Pay Fund obviously is employing all the techniques that you took us through to try and enhance or reduce, should I say, volatility and longevity risk.
Mm-hmm.
But just wondering, if people do make an allocation to the Future Pay Fund and they're already practicing bucketing to an extent, what effect will that have on their current strategy if they make an allocation to the Future Pay as well?
Yeah, Darren, that's a really good question. That's one that we've had several times. So the first is that we would say that this does use some of the techniques of bucketing, but can be in a very effective asset within a bucketing strategy. So what do I mean by that? Well, if you're running a bucketing strategy, a simple one, let's say, where you have growth assets like equities and cash assets, then what would be the ideal growth asset? Well, it would be one that spits off a fixed income that grows with inflation to fund your cash bucket every year. And it should have capital that grows at or above inflation to keep growing with your expense needs. So that's exactly what Future Pay does. So it actually is a very useful tool for investors to have to put into their growth bucket. In addition, because it has a built-in reserving strategy within it, it's more conservative than the general fund. So what this means is typically investors could consider reducing the amount of income that they have in their cash bucket when they're using it. So instead of perhaps having 36 months worth of income or 24 months worth of income, they could reduce that by 6 months worth of income, knowing that there's some stability in the underlying investments. I referred in my presentation to a report by Rice Warner, which is available if you want on a website, and they look into this in more detail, showing you that within a bucketing strategy or outside a bucketing strategy, it can be a really useful tool. It's a good question, Darren. Thank you.
And well, I've got another one to put through here, Craig. Can you clarify that the 4.2% per annum or percentage is guaranteed?
Yeah, thanks, Mari. So the answer is no, this is not a guarantee. So if you want a guaranteed product, you will have to work for an APRA regulated entity like a pension provider, like Challenger, for example. This is not a guarantee. However, our expectation is that we can provide this fixed income going forward. There are circumstances where it may not be the case. So we're doing this on a best efforts basis.
How does Magellan manage the inflows to and the outflows from the cash bracket or bucket in the future pay instrument?
Yeah, thanks, Janice. That's a great question. So if you think just back to the intuition here of bucketing, what people typically do is they say, okay, look, if equity markets have performed really well, like they have, for example, in the last 12 months, then they will take some of that upside and reserve that into their cash bucket. And conversely, if equity markets have fallen a lot, say, for example, what they did through 2008, 9, 10, then they will start using some of that cash bucket to support their income rather than having to sell down assets. And that's exactly the intuition that we are using with the structure of future pay. On top of that, so it's a very disciplined process. So it happens every day. We sort of monitor the markets and the levels, and we ensure that the appropriate amount is done. And we also, there's some mutualization here. So the cash bucket for Magellan Future Pay has not only the contributions from the fund, but there's actually $50 million that Magellan has set aside to support that, so that, you know, if there's some really difficult times in the near term, Magellan's got the back of that cash bucket, which is a very, very powerful tool here.
Just one last question from me, Paddy. I was just wondering if people want to make an allocation of the fund, what the minimum investment amount might be.
So I think if you go direct to the fund, it's a $10,000 minimum investment. But because it's a listed entity, you can just go and buy any number of shares you want. And so the share prices are, you know, about $5.90, I think. So I think you can buy one share. I'm not sure what the minimum lot size is, but, you know, it's not going to be a problem.
Okay, terrific. Well, thank you very much for taking us through that session, Paddy. It was really great and a really powerful investment philosophy, obviously, to address something that's been discussed for a while, but obviously with the low interest rate environment and low return environment from cash continuing, new ways to try and boost revenue from portfolios is obviously very welcome. So thank you very much for the presentation today.
A pleasure, Darren.